Hi everyone, now we're talking about money in the US economy. While the budget remains enormously important, the Federal Reserve Board of Governors administers the Federal Reserve System. It has 7 members who are appointed by the President to serve overlapping 14-year terms. Its most important monetary policy decisions are made by a Federal Open Market Committee, which consists of the 7 governors, the President of the Federal Reserve Bank of New York, and the President for other Federal Reserve banks who serve on rotating basis. Although the Federal Reserve System periodically must report on its actions to Congress, the governors are, by law, independent from Congress and the President. Enforcing the independence, the Red Congress is most important policy discussion in private and other discourse them only after a period of time has passed. It also raises all of its own operating expenses from investment income and fees for its own services. The Federal Reserve has 3 main tools for maintaining control over the supply of money and creating economy. For most important is known as open market operation or the buying and selling of government securities. To increase the supply of money, the Federal Reserve buys government securities from bank, other business, or individual, paying them with a check that it prints. When the Fed checks are deposits in banks, they create new reserves, a portion of which bank can lend or invest, thereby increasing the amount of money in circulation. On the other hand, if the Fed wishes to reduce the money supply, it sells government securities to banks, collecting reserves from them. Because they have lower services, bank must reduce their lending, and the money supply drop accordingly. The Fed also can control the money supply by specifying what reserve deposit-taking institution must set aside either as currency in their vault or as deposit at their regional reserve banks. Raising reserve requirements forces banks to withhold a larger portion of their funds, thereby reducing the money supply, while lowering requirement works the opposite way to increase the money supply. Banks often lend each other money overnight to meet their reserve requirements. The rate on such loans, known as federal funds rate, is a key gauge of how tight or loose monetary policy is at a given moment. The Fed's third tool is the discount rate or the interest rate that commercial banks pay to borrow funds from their banks. By raising or lowering the discount rate, the Fed can promote or discourage borrowing at the certain amount of revenue available to banks for making loans. These tools allow the Federal Reserve to expand or contract the amount of money and credit in the US economy. If money supply rises, credit is said to be loose. In this situation, interest tends to drop, business spending and consumer spending tend to rise, and employment increases. If the economy already is operating near its full capacity, too much money can lead to inflation or decline in the value of dollar. When the money supply contracts, on the other hand, credit is tight. In this situation, interest rate tend to rise, spending levels off or declines, and inflation abates. If the economy is operating below its capacity, tight money can lead to rising unemployment. Many factors complicate the ability of the Federal Reserve to use monetary policy to promote specific goals. However, for one thing, money takes many different forms, and it often is unclear which one to target. In its most basic form, money consists of coins and paper currency. Coins come in various denominations based on the value of dollar. The penny, which is worth 1 cent on 100 of dollar, the nickel 5 cents, the dime 10 cents, the quarter 25 cents, a half dollar 50 cents, and the dollar coin. Paper money comes in denomination of 1, 2, 5, 10, 20, 50, and $100. A more important component of the money supply consists of checking deposits and bookkeeping entries held in banks and other financial institutions. Individuals can make payments by writing checks, which assembly instruct their banks to pay given sums to the check's recipients. Time deposits are similar to checking deposits, except the owner agrees to leave the sum on deposit for a specific period, while depositors generally can withdraw the funds earlier than the maturity date. they generally must pay the penalty and forfeit some interest to do so. Money also includes money market funds, which are shares in pools of short-term securities, as well as a variety of other assets that can be converted easily in currency on short notice. The amount of money held in different forms can change from time to time depending on preferences and other factors that may or may not have any importance to the overall economy. Further complicating the Fed's task, change in the money supply affects the economy only after a lag of uncertain duration. Monetary policy and fiscal stabilization. The Fed's operation has evolved over time in response to major events. The Congress established the Federal Reserve System in 1913 to strengthen the supervision of banking system and stop bank panics that had erupted periodically in the previous country. As a result of the Great Depression in 1930s, Congress gave the Fed authority to vary reserve requirements and to regulate stock market margins, the amount of cash people must put down before buying stock or credit. Still, Federal Reserve often tended to defer to the elected official in matters of overall economic policy. During World War II, for instance, the Fed subordinated operating to helping US to issue borrow money at low interest rate. Later, when governments sold large amounts of treasury securities to finance the Korean War, the Fed bought heavily to keep the prices of the securities from falling, thereby pumping up the money supply. The Red resettled its independence in 1951, reaching a record with Treasury that Federal Reserve policy should not be subordinated to Treasury financing. But the central bank still did not stray too far from the political orthodoxy. During the fiscally conservative administration of President Dwight D. Eisenhower, for instance, the Fed emphasized price stability, the restriction of monetary growth, while under more liberal presidents in the 1960s, it stressed full employment and economic growth. During much of the 1970s, the Fed allowed rapid credit expansion in keeping with the government's desire to combat unemployment. But with inflation increasingly ravaging the economy, the central bank abruptly tightened monetary policy beginning in 1979. This policy successfully slowed the growth of the money supply, but it helped trigger sharp recession in 1980, 1981, 1982. The inflation rate did came down, however, and by the middle of the decade, the Fed was again able to pursue a cautiously expansionary policy. Interest rate, however, stayed relatively high. The federal government had to borrow heavily to finance its budget deficit. Rates slowly came down too, and the deficit narrowed and ultimately disappeared from the 1990s. The growing importance of monetary policy and diminishing role played by fiscal policy in economic stabilization efforts might reflect both political and economic realities. The experience of 1960s, 1970s, and 1980s suggests that democracy-elected governments may have more trouble using fiscal policy to fight inflation than unemployment. Fighting inflation requires government to take unpopular actions like reducing spending or raising taxes, while traditional fiscal policy solutions to fighting unemployment tend to be more popular since they require increasing spending and cutting taxes. Political relatives, in short, may favor a bigger role for monetary policy during times of inflation. So that was about money in the US economy and monetary policy and fiscal stabilization. Thanks everybody for watching. Hit the subscribe and bell button on. Also, don't forget to put a like under this video.